everyone. I'm Dawn Loding, realtor with eXp Realty, and today we are having a call with my good friend Amber Woodard, who is a partner with her husband with the Credit Couple. And we are talking about the basics of credit. Why are we doing this? Because this year I have made it my personal mission to really take care of my finances, to get them in order so that I know where my money is. So my money is working for me, not just me working for my money. So this is a big step for a lot of people, really understanding what your credit report even is. I know a lot of us just think, okay, well, here's the score. It's 700. That's good enough. But there's so much more to it. And today, I believe Amber is going to get us started on this. Thank you so much, Amber, for taking this journey with me. I really, really appreciate you. And I'm so happy to just really hear what you have to say today.
All right. Thank you for having me today. And, we've gone through budgeting. We've gone through, knowing what your goals are. And now we're kind of to my bread and butter. I wouldn't have gone into learning all about the budgeting and the saving and making your money work for you if I had not ended up in this credit business. So this is really where everything started for me. And then we built from there. And today, like you said, we are really just going to go over the very basics. There is so much we can go into. We may have to do like a Q&A complete podcast of just answering questions, because there is so much that revolves around the credit and branches off into everything else that we've been talking about, from the budgeting to, having the goals and the things that you want to purchase in the future. So I wanted to kind of get started today. Well, I guess first, for those of you who this is your first time, or maybe you don't know who I am half of, and you can bring my screen up and show, I think the first one is me and my husband. We are the Credit Couple. And we started this business about, I want to say over 4 years ago, kind of on accident. It just kind of fell upon us and we ended up falling in love. We fell in love with what we do. We fell in love with our clients. And we really built our initial business, our first business, around credit repair and credit building, but really a lot of credit education. We even take the time to go into high schools and teach kids just a little bit about what they're going to need to know about their credit when they start their adult lives. We usually talk to seniors, so it actually becomes relevant to them. Can I switch this? I think I can, actually.
I think you just run your computer. There you go.
Awesome. So really, I mean, credit score, credit, a lot of us don't have an education, but it's funny. A lot of people don't really, you couldn't give a definition of what credit is. So we say that credit is an extremely judgmental, sadly, 3-digit number that represents how likely you are to pay back money. It's a measure of the risk you pose to the lender. They are basically, back in the old days in the Wild West, if you wanted to go have some money, some credit at the local grocery store, they would just go next door and ask the blacksmith, do they always pay their bill? Or they would go and ask the doctor, do they always pay their bill? And it was small and everything was kind of condensed, but now the world's much bigger. And, Capital One can't exactly just go ask your lender if you pay your bills. So that's why credit scores were developed, is just so that they can show lenders how big of a risk you are. I have this kind of set up here for more towards home buying, but really this goes into anything. Credit score is going to determine whether or not you get a loan, whether or not you get finance for your car, whether or not you get a house, or whether or not you get a credit card. It's going to determine your interest rate on any of those things. It can determine your down payment. It can determine if you're getting a credit card, if it's secured or unsecured. So these credit scores have a lot to do with everything in everyone's life. It can determine your insurance rates on your car. It can determine, there's a FICO score. We'll go over this in a minute. There's a FICO score for security clearance. There's a FICO score for job clearance. Certain jobs, I know mortgage, for example, you have to keep a certain credit score or they feel that you are not a good representation of the company. So how is your credit score calculated? This is a big one, and a whole lot goes into this. The biggest part, you see here, it says 35%. The biggest part of your credit score is your payment history. And we always tell people the absolute worst thing you can do is make a late payment, because that is 35% of your score. And it says on here the last 24 months are the most important. I had a friend recently in the last year had worked her credit score up to 750. She was doing great. She is old school, so she got paper bills. And she moved, and her Kohl's bill, she never saw it. She was moving. She paid after 5 on that 30th day. The late payment took her down to 6, I believe it was 620 something, over 100 points that she lost for one late payment. So payment history is huge. After 24 months, the impact of that late payment decreases. But, right now, we knew that the COVID fallout was going to be terrible. But we have so many people that got behind on bills during COVID. Those late payments are still killing their credit. And I know, there are certain loan types for mortgages specifically have a late payment in the last 12 months, and some of them it's 24. So these late payments have just a huge impact on your score. The good side of this, the bright side, I guess you could say, of this, if your car payment is due on the 5th, and you have a grace period till like the 15th where you don't get a late payment fee, but you have 30 days before that's considered late to the credit bureaus. So if you actually read the definition of a late payment as related to credit, it's more than 30 days late. So I have a lot of people who said, well, I forgot to pay it. They put a late fee on, and I thought, well, I'll just double up next month. You got a late payment now on your credit. If you had just paid that, $14 minimum payment when you figured out that you were late, cover that late charge, you would have never had that show up on your credit. So payment history is a big deal, but I think because it's a big deal, they do give you that leeway. You have to be more than 30 days late for that to report onto your credit. My suggestion for that, and I know that we've been talking budgeting, everything needs to be on an automatic payment. Everything needs to go on that automatic payment. I do the same thing. I'm a mom, I'm a business owner, I'm a wife. If I was left to pay my bills on a certain day, they would not get paid. And I would spend so much time wondering, did I pay that? Did I get that for this month? Because that's just how I work. So setting up automatic payments, I think, is huge. Do you have yours, Dawn? Are yours on automatic? Do you have them come out?
Heck yeah, automatic.
Otherwise, I really think that my credit score would be awful, and it would just be from forgetfulness.
As you said that, I remember back to when I did it, and because I would only pay bills as I got a closing or something. And so it was just that transition from going from old school to new school to current time is huge. And you're right. Like, it was so stressful just wondering, waking up on the 6th thinking, oh my God, I forgot to pay that bill that was due on the 5th. Mm-hmm. And then, yeah, so definitely automated everything.
I have to. So payment history, huge. The next thing, and a lot of people, I think, I know I didn't know this before I got into credit. 30% of your credit score is your capacity and amount owed. Now, this is the one thing that you as a consumer have the most control over. This is your utilization. It's how much of your credit card balances you have spent. So if you have 5 credit cards for $1,000 each, and so you have $5,000 in credit card limits, and they're completely maxed out, you are likely losing over 100 points on your credit score. When you go over the limit on any one card and it reports as over the limit, you lose even more. They say, you always see, on social media, to keep your credit card balances under 30%. There's some truth in that, and there's some bad information in that. It's actually under 29%. It's actually under 28.9% is where the threshold hits. So you got to keep it a little bit lower than that. And we tell people it's not bad to have a 30% utilization if you aren't going to make any large purchases in the near future, or you're not going to need to have a high credit score to be judged for any reason, you know. But here's the truth, and we were reading this the other day, and it made a lot of sense. Joanne and I were discussing it. The credit card companies want you to keep your credit cards at 30%. They give you a bonus on your credit score when you get it under that 29 or 28.9%. And there's a reason for that. That is about the perfect number that you have a low minimum payment and you keep making that minimum payment and your balance will never go down. That is generally, for the average interest rate, that is the perfect place to have your balances to keep you paying them money forever and ever and ever. So while we think, oh, well, we get this bonus on our credit for going under 30% or being at 30%, the truth is the credit card company is getting a bonus too. Because if you keep it at 29, 30%, you're going to pay for it the rest of your life, you know? So we always tell people the best place to keep your credit score is actually not or your credit limits or balances is not zero. It's absolutely not zero. Zero will make your credit score drop. It'll also do some other things to your cards that you won't like. But to keep your balances between 2 and 9%. So, for example, if you have $1,000 in credit cards, you want to keep it between $20 and $90. And I'll explain, there are other tricks. Next month, we're going to go into some of the tricks that really will help you play the credit game. But keeping that utilization really low, but there is how you have the best credit score without going into debt.
I love that you say the credit game, like how to play the credit game. Like I so want to play that game now.
Well, and the truth is, I mean, I always tell people it is a game and it's a stupid game because some of the rules, and like I said, we'll get into more of it, but when you pay off your car, your credit score drops.
Well, and you know what, Amber, like we've talked about this before, but so much of this and money itself is such a scarcity thing for so many people. It's a mindset that you don't have enough and you don't have what it takes to go out there and make more. And I've been there and it's so true. And so if you can get your money in a place where it's more of a game and it's a game that you're trying to win and make your money work for you, that's the game I'm playing this year. I've spent my entire life in that place of scarcity and negative and just not ever having enough. And I'm studying people that don't do that and trying to figure, and I'm being completely vulnerable here, but I don't want to be there anymore. But it is such a mindset thing from how you were programmed that you have to change your programming. You have to think of it differently. And that's the game I'm playing this year. So anyway, it's a crazy game.
Well, and that poverty mindset is, I mean, it's hard to overcome even when you know what it is. And you know,
and when you make 6 figures a year, like it's still there.
Oh, Juwan and I, we actually started another business yesterday. Juwan had to hit that enter on the credit card, you know, and put it in. And I'm going like this. And I'm like, I know it takes money to make money. Yeah. I know these investments and things are important for my business. But at the same time, that poverty mindset kicks in of, what if I don't make any money next week? I know I'm going to make money, but it's there. And I don't think I'm the only one that is afraid to put in money or afraid to make changes or afraid to make leaps.
You're not at all. There's even, I mean, those of us that do make a lot of money, or I don't want to say a lot, but more money than average, like it is just still a struggle, no matter where you're at in this game. If you're a level 1 and just getting your credit going, like one of my younger sons, you know, he's like scared to death to get a credit card because he got his first one and then maxed it out and was like, wait, this is, you know, not what I meant to do. And then something else happened and he needed to get a credit card for his vet to pay an emergency bill. He had to get a care credit. And he was just like scared to death. But I tell you what, he's like, oh, I'm paying that thing off as soon as possible. He learned very young. I didn't learn young. I was like, oh, there'll always be enough money. I'm either going to hang on to it or spend it in the wrong place. And so, but that's not how you think. You've got to get in this game. And that's what we're trying to put together. What's your new business? Sorry, I interrupted.
Oh, we are going to be doing student loan consolidation
and
plans. We're going to actually be able to help people get, to where it's not being taken out of their taxes, stop their wage garnishments, all that stuff. With the new student loan stuff that should be coming out over the summer from the government and going back into repayment in August, we want to have everyone we can set up to have an extremely low payment, not be in default anymore, because they're going to throw those right back into default if you were there before.
And so I think that we should make our next call be all about that.
Well, we are for sure
ready.
The government says that this will happen. They have to have the answer. Everything, there's a date in June. I'm not sure what date, but it's in June. And then the student loan repayments will start back in August. So our summer plan is to reach everyone possible and get them set up on a good repayment plan. Make sure that if they were in default before, they're out. If their wages were being garnished before, it's no longer going to be garnished. If their taxes were being taken before, that's no longer going to happen, and that they actually have an affordable payment plan to get them through getting these things paid off. Because the good news is, once they go back into repayment, if this passes with the government, if you're making your payments, there will no longer be interest on student loans. So we all have a fighting chance now. I feel like before, no matter what I paid, my balance went up. But we all have an actual chance to get our student loan balances worked down now. I think that's going to be huge. Yes.
Awesome. Okay, well, when you're ready, we will make a call either in May or June for you about that. Or we'll just do an extra call. How's that? We'll do an extra call and I'll add it to this series on my YouTube channel.
Oh, perfect. Yeah. I think that'll be perfect. I want to get as many people into a good plan as possible. But yeah, and what you were saying about this game, about the credit cards and the credit in general, I always tell my clients, my goal for you is that your credit cards are making you money.
Yep.
My goal for you is that you get to a point slowly and over time. We definitely do very, very much baby steps with the credit cards and the credit in general. But my goal is to get you to the point where you have a card that's getting you airline miles. You have a card that has great cash back. You have cards that you can balance transfer when deals come up between. Like, if you're playing the game correctly, your credit cards are making you money.
Well, I'm definitely not, because I'm not a detailed person, and I'm like, fix it and forget it. Put it on auto pay. Know it's there. Try to get it paid down. Like, that's where I am. And then I go on a trip with one of my realtor friends, and she's like got 5 credit cards that she's using to get the miles. And she's like, well, I paid for this whole hotel, my airfare, everything using miles. And I'm like, oh my God, I have to do that. But I don't have time to sit and research and figure out how to do that. So I love that you're going to talk about that, and that you do the research. You just tell me which one to get and I'll get it, and tell me how that game is played. You show me how to play the game.
And it's ridiculous. And like, we'll go into it in the future, but there are tiers of credit cards. There are tiers you don't want, tiers, but you have to start with them. And it is a game, and a game takes time.
Okay.
This is not a trick that you can do. You can't say, starting next month, I'm going to have 3 airline cards and 2.
No, I get that totally.
And so it's one of those things where when people start, if they don't have credit cards, I want to get you on one, and I want to get the habit started. If you've got multiple, I want to get them paid down and then get the habits started.
Okay.
And we build from there. But that utilization is key, because once you have those credit card balances down, your score could go from a 600 to a 700. And that makes all the difference in what you're able to get. You know, there's been a point in time where Juwan and I had 700 credit scores, but we had high utilization. We would get denied for things not based on our credit score, based on how much money we had in our credit cards. So it's a game and you have to play it. It's getting through the bad part of the game and then getting to the fun part of the game. That's the journey.
That's what I'm excited for. So we're playing this game, y'all. I'm going through this with Amber in the background all right now. So yes, that's why I'm having her on here and we're doing this. So let's get back to your slide here. So
yes, 15% of your credit is your length of credit. So this is your history. I had a lady call me yesterday and we're talking and she has COVID hit her hard. It hit her really hard. And right now her scores are in the low 500s. But I looked at her history and I said, you are 30 years old and you have a solid 10 years of history, you know, minus what COVID took from you, minus those late payments, minus the credit cards that you let go. So having a long history, I told her that's a plus for you because we're going to bounce back faster. You're going to bounce back so much faster. 15% of your credit score is how long you've had accounts, and it's an average. And that's why we're careful a lot of the time, because if I have somebody that has a really long, they opened a bunch of cards 15 years ago and have done nothing since. If I go have them open 5 lines of credit next month, their score is going to drop. Because we're taking that average length of history from 15 years and now it's going to be 7 years. So length of credit history is important. That is often why when people go to buy a home or a vehicle, they will get a trade line or become an authorized user on a very old card. And because they need that history. And that's why a lot of times, you know, let's say your son, let's say that we're working to build up his credit and we get him some installment lines and we get him some credit cards going and everything is great. He's going to have decent credit, but then he goes in to make a purchase. Anyone that's looking at his credit report is going to go, where's your history? So credit history is important. And that's why, like, even if you say, hey, I don't want to buy a house for 5 years, you get started now. It matters. Yeah. And negatives stay on your credit 7 to 10 years. So
any way to make those get off?
That's like what So that's where we go in and dispute and get those things deleted. I can't guarantee anytime, no one can, that any particular item will come off. But in general, yes, with enough fighting and arguing and all that good stuff, we are able to remove most negative things from a credit report. Sometimes all, but most of the time, I would say we can get about 85, 90% off. Awesome. But the thing is, the newer they are, the worse they are. And those late payments are killer. So keeping that credit history, keeping it good. A lot of people, and I do want to bring this up here too real fast. A lot of people are putting their children on their credit cards. And I even have a list that says that list credit card companies that don't ask for an age. So I could put my 6-year-old on my credit cards. You could put your 2-year-old on your credit cards. And people are all over are doing this. This is a big thing on social media. And I just want to bring up a point. What happens when you are in a horrible car accident and can't work for 8 months and you can't pay your bills? What happens when your spouse runs away and your life takes this temporary turn for the worse and you can't pay your bills? Those cards that your kids are on, that goes on their credit history. Every mistake that you make, and none of us are perfect, is going to go on your child's credit history. Now, if you wait till your child is 17 years old and you add them to your credit card, and you know that credit card's been good for all of that time, they still get all that history, but you don't have to take that chance that during that 17 years you make a late payment. So I always tell people, wait till your kids are about to get out of high school before you add them to your credit card. Honestly, wait until they're about to use their credit.
I've never added a kid to my credit cards. I make them get their own.
Well, it's a great way to get them that history.
Gotcha.
Especially if you have a child who's wanting to be an entrepreneur and they're wanting to start building their credit to build business credit. You know, those things are really important. But when I work in credit, And I would not add even my 11-year-old, 12-year-old this week to my credit cards, because anything can happen between now and when she's 18. So that's kind of my opinion. It just worries me a little bit. A lot of people adding their toddlers to their credit cards.
Yeah, that's crazy.
It is, but it's so advertised. And when you don't know much about a topic and social media goes viral over something, everybody thinks that
that's the news. Like, that's the do this. That's
and then
crazy.
it makes me angry sometimes.
I bet.
We have this 10% is new credit inquiries. And a lot of people don't know this either. I have a lot of people that I look at their credit and they've got a lower credit score, and they have 36 inquiries in the last year for credit cards at every store you can imagine. They've got 5 applications at Old Navy, and they've got 4 at JCPenney, and they've got 7 at Kohl's. What are you doing? Well, they offered me a coupon. I got 30% off. They said, even if I was denied. And every inquiry over 5 is taking 3 to 5 points away from your credit score. When you are applying, even if you're just being silly and trying to save money, when a lender pulls that up, remember, they're looking at how big of a risk you are, and they see that you're applying for credit like every month. They're going to go, are they desperate for money?
Yeah. It tells a story. It literally tells your story.
Yes. And especially, I've had times, I believe one of my reports has 7 inquiries currently. One is about to fall off. But if you look at my reports, I have 7 inquiries and I have an account open to match each one. When you're going in and just getting yourself denied over and over and over again, it really does start to tell that story that you were desperate, even though you were just desperate to save 40%.
Yeah.
It really is something to think about, because they stay on there for 2 years. I know a lot of people say 18 to 24 months. I've never seen an inquiry just fall off after 18 months. It's 24, sometimes 25. And the last 10% is going to be your types of credit. And I really think, they put this in as 10%, but it has it goes into your length of credit history and your utilization, your payment history so much. Having varied accounts, multiple accounts open, is so important for your credit. We have revolving credit. That's going to be your credit cards. Everybody knows about those. And a line of credit. You'll often get this through your bank. They'll say, okay, you have a $2,000 line of credit. You can take out as much as you want. As you pay it back, it opens back up. This is revolving credit. You want to have 3 to 5. When you're just starting, we're going to start you with 1. Quickly as we can, build up to 3. 5 may not happen for a few years. A lot of people have 20. And if you can manage 20 credit, I have a referral partner. He threw out his credit cards one day, and I think there was over 50. Like, he literally just had stacks. And he says, I collect credit cards. It's something but he manages them. If that's how you want to spend your time, that is great. But 3 to 5 is great. 3 to 5 good credit cards is a good goal to have. You're going to have open credit when you need it. You're going to have good credit lines. Hopefully those cards are getting you cash back. But if you only have 1 credit card and you're trying to get a 750 credit score, it's going to be difficult. And the same goes for your installment credit. Installment credit is going to be your loans, mortgages, cars, anything that once you pay it off, it's gone. So you need to have at least 1 or 2 good installment lines going. And next month, I'll kind of go into, we have some ones that, because I would never tell my client, hey, I'm going to need you to go buy a car. Like, I know you have a perfectly good car, but we need to build your credit. Go buy a car. We have different options depending on where you're at right now that will work for you to help you build up that installment credit. But having both types of credit, having open accounts with revolving and installment credit is really, really important, because it's 10% of your score. How much time do we have, Dawn?
Well, we're at 30 minutes right now, so
I think I just want to hit this one here, and I think we're going to be done for this week. Yes. I'm going to hit this one here, and then we can stop for this week. And then next month, we will get into the actual good stuff that everybody wants to hear. So This is something that is a huge piece of debate also on social media. Everybody says, why is Credit Karma lying to me? And they say, how come my Credit Karma says this and I went to go buy a car and they said it's that? And I'm like, well, if you went to buy a house, they would say it's something totally different as well. There are two main schools, I guess you could say, for your credit scores. You have the FICO models and you have the Vantage models. They both have the same range, 300 to 850. FICO is generally going to be used by your lenders, and I'm talking for your car, your house, most banks, they're going to use FICO. Vantage is not used by most lenders, but I will tell you it's used by almost every credit union. So they are both used. Vantage has multiple models. FICO has over 100 models. When I speak of the game, the bad part of the game, this is part of it. I think it's done to confuse you. There is no reason that we need to calculate your score this much different, 100 different ways, in order to find out if you as a human being are a risk to a lender. But this is how it's done. Some big things that you need to know about these. When you have a collection and you're always, you hear on social media, don't pay any collections. This is not your debt, whatever it is that they're saying at the moment. And then you hear, well, you want to buy this house, I need you to go pay off all of this stuff. Or your conscience tells you, I bought these things and I need to pay them off, which I completely understand. Your Vantage scoring model, what you see on Credit Karma, most likely what your bank app is giving you, these free, these CreditWise and all of this, they're going to give you your Vantage model. The one that is not used by lenders is going to disregard a paid off collection. So if you had an old credit card that was in collections, you pay it off, it's still going to show on your report, but they don't average it into your score. Okay. But, and this is where you get the big difference in FICO and Vantage. On FICO scoring models, you pay off a collection, it's still in your credit report and nothing happens to your score. You might get 3 to 5 points. You're not going to get that 26 to 32 points that you got with Vantage. So this is one of the things that causes the big discrepancy in the scores. Also with FICO, if you have a mortgage, mortgages count. There's no real good way to describe this, but when you make a payment on your mortgage, it's almost like making 2 payments on your credit card. It's kind of double. They put a mortgage at a higher level and it counts better for you. In the same breath, if you miss a mortgage payment, it's worse than missing a credit card payment. So these two models are both used to measure your risk. They're both used by different, I want to say lenders, but mainly Vantage is used by credit unions. They're both right. They're just calculated differently. The reason that FICO was the original, the Vantage came out because, and this wasn't you that I ran into with a client. One of my other realtors I ran into, she said, I have a bunch of clients that just went through Dave Ramsey. And this couple wants to buy a house in the next couple months. And I know that you help build credit, but they don't have a score. I can't help them because it takes 6 months to establish a FICO score. Now, if you have an 18-year-old who goes and gets a Capital One card tomorrow, it's going to show up in a month or so on their Vantage score. You're going to be able to see it. It's going to help start building their score. Their score is going to appear. Their score will start to go up. But their Vantage score will not register anything for 6 months. You have to have 6 months history before you even show up on FICO. So Vantage was actually made by the credit bureaus to help people who don't have a very long history or a good profile. It's supposed to help them be able to prove their credit worthiness with less information. That's just not how it's promoted. It's promoted as being your credit score. It's really kind of a pre-credit score. But they're both good. They just measure different things. I'm telling you right now, you could pull all of your FICO scores and they're all going to be different as well. So Vantage is not a lie. It's not telling you bad information. I use Vantage with my clients because it's much cheaper for them for me to pull Vantage scores. And I can tell them relatively close as we move along about where their FICO score is, just not exactly.
Got it.
That
Cool.
is a huge thing that it's done to confuse.
I have a dog who is wanting to go outside and she's like in my lap.
I thought I heard toenails moving around.
Oh yeah, they're all like, you forgot to let us out. So anyway, sorry for the commotion.
You're good. And I think that's about it for today. I know that credit can get kind of intense and involved, and me being passionate about it can make it worse. So I don't want to go too far.
I'm super excited because I want to play this game. Like, I want to go at this a different route. I'm at that age now where, you know, I'm ready to do it a different way, and I got nothing to lose. So I'm ready and we're doing it. So I hope that you guys out there watching the recording will reach out to Amber or me or somehow someone to get in the game. That's the important thing, is just get in the game. It's a money game, and it's all about making money, but it's not just about that. It's also about managing your money. You have to be a good money manager to build wealth. That is what I'm learning from looking at the very wealthy people compared to the ones that are not. And they're good at the game. They're good money managers. They have their stuff diversified, which, you know, I did not do when my EXP stock was really good. And now I'm just waiting for that to go back up. So it's all a game, though. There's no win or lose. There's you might have a bad year. You could build it back up and have a good year. It's a mindset game also. So get in the game.
I agree. And it's just, knowledge is power.
Yeah.
You know, you have to understand and you have to know before you can really play the game. You can't jump in before you read the rule book.
And you don't necessarily have to learn it all on your own. Having a good team helping you play the game and coaches, that's key, because you don't know what you don't know. So get the help that you need. Invest wisely. All right, girl. Thank you so much. And thank you, everyone. I hope that you're enjoying this series. Next week, I will have guest attorney Fred Cludius on, and we will be talking about estate planning, something else I'm doing this year. So we will see you next week in the Financial Freedom series. Thank you so much.
Thank you.
Go make it a great day.